All right, everybody. This is the final chapter. I'll probably say it's the most important chapter. A little bit longer video here. A lot saved. The pink ones I've done in a different reading. The other ones I did in a previous reading. And as I read it again, I had more thoughts. If you ask me to distill trading down to its simplest form, I would say it's a pattern recognition numbers game. Once you see a certain pattern form and you know what your edge is, you take the edge and then just base it on probability. Because the more you think you know, the less successful you'll be. It talks a lot about people that overanalyze and they just study. And sometimes you get analysis paralysis where you're not even sure what to do. First stage when you're trading is mechanical stage. In this stage, you build your self-trust necessary to operate in an unlimited environment, learn to flawlessly execute a trading system, train your mind to think in probabilities, the 5 fundamental truths we talked about earlier, and create a strong, unmistakable belief in your consistency as a trader. Knowing that you're going to be consistent, you're taking your trades at the exact moment and following your plan. One explanation may be that they grew up with extremely unusual parents, teachers, and coaches who, by their words and examples, taught them to correct their miscalculations and errors with genuine love, affection, and acceptance. I say extremely unusual because many of us grew up with just the opposite experience. We're taught to correct our mistakes and miscalculations with anger, impatience, and a distinct lack of acceptance. It's possible that for the great athletes, past positive experiences with respect to mistakes cause them to acquire belief that mistakes simply point the way to where they need to focus their efforts and grow and improve themselves. With beliefs like that, there's no source of negative charged energy and consequently no source for self-denigrating thoughts. However, the rest of us who did grow up experiencing a plethora of negative reactions to our actions would naturally require beliefs about mistakes. Mistakes must be avoided at all costs. There must be something wrong with me if I make a mistake. It must be a screw up or it must be a bad person. So remember that every thought, word, and deed reinforces some belief we have about ourselves. If by repeated negative self-criticism we acquire belief that we're screw-ups, that belief will find a way to express ourselves in our thoughts, causing us to become distracted and screw up on our words, causing us to say things about ourselves or others that reflect our belief on our actions, causing us to behave in ways that are overtly self-sabotaging. This works a lot in trading. Not every trade is going to work out. Based on that, you don't want to have the self-sabotaging thoughts. For example, predefining your risk is a step in the process of being consistent. If it takes any special effort to predefine your risk, and you have to consciously remind yourself to do it, if you have any experience, any conflicting thoughts, trying to talk yourself out of doing it, or you find yourself in a trade where you haven't predefined your risk, then this principle is not dominant functioning part of your identity. It isn't who you are. If it were, it wouldn't even occur to you to predefine your risk. It's one of the key parts of the book. Predefine your risk. Know how much you're willing to risk to see if your edge plays out. These are good statements to think about. You could say these to yourselves before you take a trade or before the beginning of the day. I'm a consistent winner because 1. I objectively identify my edges. 2. I predefine the risk of each trade. 3. I completely accept the risk or I'm willing to let go of the trade. 4. I act on my edges without reservation or hesitation. 5. I pay myself as the market makes money available to me. 6. I continuously monitor my susceptibility for making errors. 7. I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Again, this would be a good one to say to yourself before you trade. It takes about a minute. For example, if you've been trading and get a high from the euphoria of catching a big move, to impress your family and friends, be a hero, to fulfill an addiction to random rewards, to be right about your predictions, or for any other reason that has nothing to do with being consistent, then you'll find the force of these other motivations will not only act as an obstacle making the trading exercise I'm about to give you very difficult, but it could very well be strong enough even to keep you from doing the exercise at all. And the exercise is coming up. In whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Again, no extraneous or random variables that could enter your equation. They give a few ideas on what type of plan you could use for your edge here. Taking profits, believe it or not, of all the skills one needs to learn to be a consistently successful trader, learning to take profits is probably the most difficult to master. A multitude of personal, often very complicated psychological factors, as well as the effectiveness of one's market analysis, enter the equation. You might be at a good profit on a trade and you think it's going to keep going, make more and more profit, but if you're not predefining your risk and profits and not being consistent with that, you're going to probably lose quite a few of these that should have been a profit. I've seen many traders where they hit a good target profit, they let it go, and it comes back down to break even or even a loss. Accepting the risk. Requirement of this exercise, you know in advance exactly what your risk is on each trade and a 20 trade sample size. You should do at least 20 trades with your edge and not showing any emotion on what happens positively or negatively. The exercise requires that you must use a 20 trade sample size. The potential risk is you will lose on all 20 trades. So make sure you want to size appropriately here. If you need to do one contract, do one contract. If you don't have enough funds to be able to take 20 losing trades in a row with one contract, paper trade it. You got to do something in order to be consistent as a trader. Doing the exercise, trade your system exactly like you designed it. This means you have to commit yourself to trading at least the next 20 occurrences of your edge, not just the next trade or the next couple of trades, but all 20 no matter what. You cannot deviate, use, or be influenced by any other extraneous factors or change the variables that define your edge until you've completed a full sample size. Do your 20 trades completely mechanically. Don't think about what happens in a win or a loss. Just let it go. That's why having a one cancels other order with a certain percent take profit, certain percent stop loss makes a lot of sense. So once you're doing these 20 trades, you want to be aware of what happens. Obviously, log your results. Make sure that you're showing that you consistently took the edge when it happened, and also make sure that you have the proper entry and exit points with the proper entry when your edge happens, and then the take profit and loss percentages based on what you know before you start to trade. Here's some discussion questions. Douglas talks about the importance of thinking in probabilities. How does this mindset change the way a trader responds to both winning and losing trades? If you know that you're thinking in probabilities, if you have a winning trade, and let's say your edge says that it should be a 60% chance of winning, then that's based on what your probabilities say in terms of it probably will happen. If it's a losing trade, just also realize that 40% of your trades won't work, and then that's part of the probabilities as well. 2, the chapter emphasizes detaching from the outcome of any single trade. Why is this detachment so difficult for most traders, and what are some ways to practice it? As the book talks a lot about, people have a preconceived notions of, I need to win on this. If I don't win, I'm a loser. And just based on like school and learning, we have to stop our mistakes. Mistakes will happen. We don't know what's going to happen with the market. And some ways to practice the detachment is either do paper trades, do a really small account with a very small sample size of 20 trades with one contract, and be perfectly okay with what happens. It definitely helps to have other accounts, like have an emergency fund, have excess savings, where even if all the trades happen to lose out, you'll still be perfectly fine to get food on the table. 3, Douglas discusses consistency as a function of one's mental framework, not the market. What does he mean by this, and how could traders train themselves to become more consistent? Having the proper mental framework of when you take a trade is paramount. Being able to know exactly when your edge comes up, being able to take the edge without any reservations, being able to take profit and stop losses with the predefined levels that you're aware of. Those are all ways to be more consistent. And also be non-emotional about the outcome, thinking in probabilities. 4, how does focusing on the edge rather than the result of a trade help reduce emotional interference in trading decisions? The actual result of any one trade does not matter that much in the end. Having one trade with a edge that has a 60% probability of working and it doesn't work, that's all based on the probabilities. You don't know what's going to happen in the future. Remember, any one person could easily just make the opposite of what your edge is, and there's nothing you can do about that. So by being consistent and taking these trades more over and over again, you just naturally become more consistent, and then you have a good framework for being able to deal with the market emotions. 4, how does focusing on the edge, I already said that. 5, in what ways can fear and overconfidence both disrupt the trader's ability to think probabilistically? And how does the chapter suggest overcoming these? Fear could happen when you have a string of losing trades, which will happen in any type of edge. Even if you have a very highly probable trade, like you sell a 0.05 delta put and you let it expire, I mean, that's a 95% chance that it's going to work. So you might feel a bit overconfident that it's always going to work. But then, of course, that one trade comes along and completely wrecks your account. Fear could go the other way. What if you have a good edge, there's only a 30% win rate, but you're winning 5 times as much as you lose? You have a positive expectancy there, but you're going to have a string of quite a few losses in a row with that 33% edge, so you might have fearful on it. Way to overcome this would be to do your 20 trades and be perfectly okay with the outcome. Let me know if you have any questions or comments down below this video. It's been great discussing all these chapters with you, and I'll see you guys in the next video.